Hey everyone, welcome. Today we are going to tackle stock options. And I know, they sound super complicated, right? But what if I told you they're actually built on one really powerful, simple idea? And that idea is all about controlling risk. Stick with me, and by the end of this, you'll see exactly how they work.
So here's how we're going to break it all down. First, we'll look at the big problem that options were even invented to solve. Then, we'll see how they act just like an insurance policy. After that, we'll get into the nuts and bolts, figure out how they're priced, and finally, look at the two sides of every single options trade.
Let's just start with this one massive question. Think about it. Everyone wants to make money when the market goes up, but nobody, and I mean nobody, wants to get wiped out when it goes down. So what if you could get the upside without that devastating downside? Well, that exact question is the whole reason options even exist.
Okay, so to really truly appreciate what makes an option special, we gotta first talk about its older, much riskier cousin, something called a futures contract. It's a really simple deal on the surface, but as you're about to see, it has a huge glaring flaw.
Let's make this real with a quick story. Imagine a farmer. He knows that next month he's going to need a ton of soybeans, but he's worried the price might shoot up. So he makes a deal with his uncle to lock in a price today of 99 rupees per unit. You with me? This simple agreement is a futures contract. It's a promise to trade something later at a price you agree on now.
Now let's see how this plays out. Say the market price for soybeans just skyrockets to 110 rupees. Well, our farmer is a happy guy. He gets to buy them at his locked-in price of 99, which means he's instantly made an 11 rupee profit on every single unit. It's a great deal. But what if the price goes the other way? What if the market crashes and soybeans are only worth 90 rupees? Well, that deal he made is binding. He is obligated to buy them at 99, even when they're way cheaper everywhere else. He's just been forced into a 9 rupee loss. See the problem?
And this right here is the heart of the issue. With a futures contract, sure, your profit potential is unlimited. But, and this is a huge but, your loss potential is also unlimited. And for most people, that's just a terrifying amount of risk to take on.
So how do we fix this terrifying, unlimited risk? What if our farmer could somehow change the rules of the game? Well, this is where the simple genius of an option comes in.
Let's hit rewind and replay that story. This time, the farmer pays his uncle a tiny, non-refundable fee, let's say 1 rupee. And in exchange for that 1 rupee, he gets the right, but not the obligation, to buy those soybeans at 99. That one little word change, from obligation to right, well, it changes everything.
Now, that small fee? It has a name. It's called a premium. And that is not a coincidence. It works exactly like your car insurance premium. You're paying a small, known price today to protect yourself from a huge, unknown disaster tomorrow. You're buying a choice.
So check this out. If the soybean price plummets to 90 rupees now, the farmer isn't trapped anymore. He can just tear up the deal, walk away, and go buy his soybeans on the open market for the cheaper price. And what's the most he can possibly lose? Just that 1 rupee premium he paid, that's it. His risk is completely capped.
Okay, that's the story, that's the concept. Now let's bring this into the real world. Let's leave the soybean farm behind and head to the stock market. And we'll use a real stock, something like TCS, as our example.
So every single option has 3 key parts, and the insurance analogy holds up perfectly. First, you've got the strike price. That's the price you lock in. It's like your insured value. Then you have the premium. That's easy. That's just your insurance cost. And finally, the expiration date. Just like any insurance policy, it doesn't last forever. After that date passes, the option is worthless.
So that brings us to a really important question. We saw that the premium for that TCS option was 15 rupees and 30 paise. But how do they come up with that number? Why does an option cost what it costs? It's not just random.
To figure this out, let's look at a different TCS option, one that costs a lot more, 219 rupees. So where does that number come from? Well, it's actually made of 2 totally separate parts.
The first part is something called intrinsic value. Just think of this as the right now value. So let's say a stock is trading at 4,200 rupees, but your option gives you the right to buy it for 4,000. Well, that option has 200 rupees of real, solid value this very second, because you can literally use it to buy the stock at a discount.
The second part is called time value. This is the maybe value. It's the extra cash you're willing to pay for the possibility that the stock price might move even more in your favor before your option expires. So the more time you have left, the more uncertainty there is,
and the more that time is worth.
So let's put it all together for that 219 rupee premium. As you can see, the huge majority of it, 200 rupees, is its real, tangible, intrinsic value. That leftover 19 rupees, that's the time value. That's what you're paying for hope, for the chance that the stock could climb even higher before time runs out.
All right, for our last piece of the puzzle, let's look at the two people in this dance. For every person buying an option, there has to be someone selling it, and they are making two completely different kinds of bets on the future.
And here it is, the fundamental trade-off. The option buyer is the one who pays that small premium. They get a shot at unlimited profits, but their loss is strictly limited. They're basically buying a lottery ticket. The option seller, well, they're on the other side. They're the ones collecting that premium, and they're betting that lottery ticket expires worthless. Their profit is limited to that small fee, but the potential loss is, you guessed it, unlimited. They aren't buying the ticket, they are the casino.
So who actually has the better odds of making money? The data is pretty clear. Just like at a casino, the house tends to win over time. The seller, the casino, has the statistics on their side. While the buyer is dreaming of that one massive win, the seller has a much, much higher probability of just quietly pocketing the premium month after month.
So let's just quickly recap the big ideas here. An option gives you the right, not the obligation. That is the most important part. It's best to think of it like an insurance policy for stocks. For the buyer, your loss is capped at whatever premium you paid. You're making a low probability but high reward bet. And selling is just the opposite, a high probability but limited reward bet.
And this all leaves us with one last big question. Are options a shield, or are they a sword? You can use them very conservatively to protect your portfolio, just like insurance. Or you can use them to speculate, swinging for the fences like it's a lottery ticket. The tool itself is neutral. The choice between protection and speculation, well, that's up to you.